So the next section we want to talk about is the operating cycle. So the operating cycle is often called the cash-to-cash cycle. And it's an important thing for organizations to keep in mind because cash is very important to all organizations. So when you think about when the cash cycle starts, it's when I have to spend money to acquire the products I'm going to sell to my customers. So if I'm either making or buying inventory, that's where my cash cycle begins. And then I have to then either make it or buy it. It sits there for some period of time. I sell it to my customer, and then my customer pays me. And so it takes me time to buy it, to store it, ship it, and then collect the money. And that cycle can take a considerable amount of time, sometimes a couple of weeks, sometimes a couple of months or longer. And this cash-to-cash cycle of the operating cycle, and it really fuels the liquidity. So some companies, it's very short. If you think about a retailer in a high volume business, commodity business, maybe fruits and vegetables, things of that nature might be a very short cycle, particularly if the customers are paying cash. But then you have other businesses where it can be a very long period. So we have to be aware of that. So it's my inventory, my credit sales, my collection, I'm getting it back to cash. So I put out my cash to make or buy my inventory. If it's a cash sale, I get it right back when I sell it. But more often than not, in large businesses, it's a credit sale. Then I have to wait 20, 30, 40 days to collect it and get it back in this cycle. So let's take a look at non-current assets. These are assets that are part of the business that we expect to keep in the business for longer than a year. And so assets, as you know, are things that we own. So the types of non-current assets are typically classified into these groupings. There's land, there's buildings, equipment, and then there's intangible assets like patents and copyrights and trademarks and the like. And then some businesses, but not the ones that we'll be looking at, will also have natural resources. So this would be more in the agricultural or the mining business, and we're really not going to take a look at those. So we're going to really focus in on the non-current assets of buildings, equipment, and then intangible assets, because a lot of pharmaceutical and healthcare businesses do have intangible assets. So one of the key things to keep in mind about non-current assets is that we typically want to reflect a decline in their asset value over their useful life. So what does that mean? So let's say I buy a piece of equipment. Let's say I buy a computer system that I'm going to use in my business, and I expect to be able to use it for 5 years. So that becomes a non-current or a long-term asset, which I put on my balance sheet, and then I have to reflect its use in my business over that 5-year period. So the method that we use to do that is something called depreciation. It takes the initial value of that. Let's say it's $100,000 for the computer system. And let's say that I expect to get 5-year life out of it. So every year I'm going to take 1/5 of the value of that and move it off of my balance sheet and put it onto my income statement. And that's called depreciation. So that every year 1/5 of the cost of that ends up as an expense, and my asset value declines by that 1/5. So I keep things in balance. Okay, it doesn't mean that the value of the computer system itself is actually less, but the financial reporting system has it reduced by that amount. Okay, so the cost is the acquisition cost. The use, so I have to determine how long my useful life is, and we're not going to worry about disposal. So property, plant, and equipment comprise the most common types of non-current assets. Property represents the land, which our offices, factories, and other facilities are located. And property is valued on the balance sheet at its historical cost. So land, which is a non-depreciable asset, just because it is. So we're not going to worry about why or why not at this point. But any cost that I incur to make a land ready for use, and there's a bunch of them listed here: insurance, legal fees, raising property that existed on the land, all that I could capitalize and depreciate. So we're not going to really worry about land because it really doesn't play a big factor in our understanding of things. But building and equipment does. So any cost I incur to buy an asset, whether it be a building or an equipment, and get it ready for use, I can put on the balance sheet as capital, or as an asset, I'm sorry. So it's called capitalization, but it's an asset. So it's the purchase price, any legal, architectural fees, permitting cost, installation cost, transportation cost, all of that goes into the value of the building or the equipment. And so, buildings, pretty self-explanatory: warehouses, hospitals, etc. Property, equipment, furniture, tools, computers, automobiles, trucks, etc. Okay, so pretty self-explanatory. And then the question is, what do I do with those assets? And the way I deal with fixed assets or these non-current building and equipment assets is I depreciate them, which basically means I look at the initial cost to put them into service, the purchase price plus whatever cost to get them ready for use in my business, and then I determine the useful life. So if I put a building in place and I assume it has a 20-year useful life, I take the cost of that building, I divide it by 20, and every year that becomes the depreciation that I record on my income statement. So that's the process of taking money from my balance sheet and moving it over to my income statement. And so this is one of the nuances of accounting that goes on a regular basis to match revenue and expenses. So depreciation is considered a rational and systematic allocation of an asset cost to expense over the asset's life. Has nothing to do with writing up or down the asset value. Okay, so depreciation, this gives us a little more example in terms of how it works. I take my acquisition cost and I divide it over my useful life, and it ends up as an expense on my income statement. So as I move it from my balance sheet to my income statement, it's an increase in my expense on my income statement and reduces the value of my asset. So here's an example that I purchased so this is an example of net book value. So if you look at the balance sheets of your companies, you're going to see that things are listed as net book value of equipment, property, plant, equipment. Sometimes it's called PP&E, net PP&E. Basically, what that's reflecting is the original purchase price less any depreciation that's been taken on that set of assets over the life of those assets. So depreciation expense goes to the income statement, and accumulated depreciation reduces the value of the asset on the balance sheet. So most companies use straight line depreciation, and that's really all we're going to worry about in this course. Straight line depreciation says I take the asset value divided by the useful life of the asset, and every year I take the same amount. There are other methods of depreciation, accelerated depreciation, where I can take more early and then less later. In total, though, depreciation under either method is going to be the same over the life of the asset. So here's the formula. So I take the cost minus any estimated salvage value, which we can ignore, and then divide it by the estimated useful life. So here's an example of I buy a piece of equipment for $50,000 with a 5-year life, and this has a residual value of $5,000. So I just take 50,000 minus 5 divided by 5 on $9,000 per year in annual depreciation expense. That goes on the income statement, and the value of my asset gets reduced by that amount each year. Okay, so at the end of year 1, the value of my asset becomes 41,000. At the end of year 2, 32,000, and so forth. So that's a straight line. method. There is an accelerated depreciation method, but we're not going to worry about these other methods, units of production methods, which are used a lot in natural resource production, and declining balance method. We're just going to skip over them. Just keep in mind that there are other depreciation methods that you should be aware of, because at the end of the day, the vast majority of the companies use straight line depreciation for its simplicity and for its predictability. So let's talk about intangible assets. There's a long list here. Patents. This is something that most pharmaceutical companies desire to protect the exclusive rights to their drug discoveries. Copyrights. It's used when you're doing something creative in the writing or music production area. And then things related to buildings, and if you're a franchisee, trademarks are pretty self-explanatory. You know, a particular trademark around Disney or Apple or whatever is well known. And then goodwill gets a little more complicated, but the bottom line on intangible assets is that we need to recognize that they're a long-term asset. They have value. And like the other non-current or long-term assets, we put them on the balance sheet, and then we have to figure out how do we move them from the balance sheet to the income statement. And so with the fixed assets, the property, building, and equipment, we use something called depreciation. And with intangible assets, while the method works very much the same, it's called amortization. So it's a way of moving the value of that intangible asset, that patent or copyright, from the balance sheet and taking a portion of that each period and putting it on the income statement as amortization expense as opposed to depreciation expense. So patents, for example, have a 20-year legal life. You can use a straight line method. You take the cost of developing the patent, divide it by 20, and every year you put that much expense on the income statement, and you reduce the value of the patent on your balance sheet by that amount. And it goes on from there. Okay, we don't need to go through the nuances of each of the intangible assets, because this is not a course to learn all the technical details about depreciation, amortization. Rather, I want to make sure that you have a high-level understanding when you look at a balance sheet, that you understand that, oh, that's what a fixed asset is, building equipment. This is how it moves from the balance sheet to the income statement. And the same with intangible assets. Patents, which is probably the largest item that you'll see on most pharmaceutical companies' balance sheets in terms of intangible assets. And this is what they represent, and this is how they move between the balance sheet and income statement. Okay, so the one exception to that is goodwill. So goodwill, you may think of goodwill as some intangible thing that we create when we do good things for others, but that's not what the accounting world refers to when it talks about goodwill. Goodwill is when I buy another organization and I pay more than the fair market value of the assets I've acquired, the difference is called goodwill. So let's say that I decided that I'm Facebook and I'm going to buy one of my competitors that does something similar. Let's say, for the sake of discussion, Twitter. And let's say I agree to spend $100 billion on Twitter. And when we've gone through and we've assessed the fair market value of all of their assets, we decide that it's only worth $50 billion. So the difference between that $100 billion that Facebook's willing to pay and the fair market value, that's what accountants call goodwill. And that sits on the income, that sits on the balance sheet, and it's a very technical way in terms of how it moves from the balance sheet to the income statement. We're not going to be worried about it in this course. There's something about looking at the net present value of future stream of cash flows and comparing that against the purchase price, blah blah blah. Too much for this course. Just keep in mind that the intangible assets, the major ones that we'll see on the balance sheets of pharmaceutical and healthcare companies, if they have them, would be patents and sometimes goodwill. Okay, so that's all I want to talk about in terms of intangible assets. And so I think that concludes everything around long-term assets or non-current assets. Okay, so get in touch if you have any questions, and we'll see you next time.